Okay, first to demonstrate how call options work, I'm going to tell you a little story. And by the way, if calls and puts are old hat to you, then you've already got a leg up. So the method I'm going to teach you afterward will be even easier for you to apply with options. Okay, here we go. So Susie's selling her house for $500,000 in a neighborhood that has a nearby parcel of land that is for sale as well. There are two parties interested in the land. Peter plans to develop the land into a beautiful park and bird sanctuary. And Harry plans to build a low-cost housing development. Now, Sammy comes along and is interested in buying Susie's house for a cash deal, but he has a problem. He won't have the cash available for 3 months. So he's of course worried that the house will be sold to someone else in the meantime. So he decides to offer Susie $5,000, or the option premium, right now, if she'll take the house off the market and give him the option. This would be a call option to buy the house for $500,000, which is referred to as the strike price, anytime within the next 3 months, which is the expiration date. Now, if he does not elect to buy the house, Susie keeps the $5,000 premium and Sammy walks away from the deal. If he does elect to buy the house or exercise the option, Susie still gets to keep the $5,000 and he pays her $500,000 for the house. Now, 3 things could happen in this story. In scenario 1, Peter buys the nearby parcel of land. This, of course, will increase the value of Susie's home to, say, $600,000, in which case Sammy will be very happy to exercise his option to buy the house for $500,000. In scenario 2, Harry buys the nearby parcel of land. This, of course, will decrease the value of Susie's home to, say, $400,000, in which case Sammy will not exercise his option to buy at $500,000, and he'll just walk away from the deal having lost only $5,000. Then there's scenario 3, where neither party buys the nearby parcel of land. Susie's house is still worth $500,000, and Sammy can elect to exercise his option to buy the house for $500,000 or not and simply walk away from the deal, losing only $5,000. In effect, Sammy is controlling a $500,000 asset for 3 months for only $5,000. No matter what happens during that time, the most he can lose is $5,000. Susie, on the other hand, is happy to take the $5,000 as she had no guarantee anyone else would buy the house at her asking price, nor did she feel the nearby parcel of land would sell anytime soon. Here's a footnote to the story. Depending on the circumstances, if Susie felt she was likely to attract another buyer in the near term, she would have demanded more than $5,000 from Sammy to take the house off the market for 3 months. Likewise, with call options, the more the underlying asset is perceived to appreciate, the higher the premium demanded by the market for that call option. So now let's define this in trading terms and look at an actual example trade. A call option is a contract between 2 parties to exchange a stock at a strike price by a predetermined date. One party, the buyer of the call, has the right but not an obligation to buy the stock at the strike price by the future date, while the other party, the seller of the call, has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $50 and you think it's going to go up to $60, you might buy a $55 call option for, say, 20 cents. If the stock rose to $60, that would allow you to buy the stock at $55 even though it's valued at $60, netting you a $4.80 profit on each share. On the other hand, the person that sold you the call would be obligated to sell you the stock at $55 at a loss of $4.80. If the stock never rises above $55 by expiration date, the call expires worthless, and the call buyer is out 20 cents and the call seller keeps the 20 cents.